The greatest threat to capital is rarely the timing of the trade. The true danger lies in the management of capital once the trade is initiated. Position sizing is the silent killer of trading accounts. A precise entry point cannot save an oversized, poorly managed position. Conversely, a slightly imperfect entry point can still yield substantial profits if the risk is correctly calibrated. Before continuing, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this content to more people. Richard Wyckoff taught that trading is a campaign. It is not merely a series of isolated bets. The professional operator views the accumulation or distribution phase as a long-term strategic play. Position sizing must reflect this strategic time horizon. It must account for the inevitable tests and shakes that occur within the schematic structure. Many retail traders believe that finding the exact pivot point guarantees success. This belief overlooks the necessity of surviving drawdowns. Survival depends entirely on appropriate risk allocation. Capital preservation is the first and most vital rule of speculation. Wyckoff emphasized this point repeatedly throughout his work. The market environment is inherently uncertain. Therefore, the trader must always prioritize the protection of capital over the pursuit of profit. A position that risks too much capital on a single setup violates this core principle. It introduces immediate emotional stress and forces premature decisions. Proper sizing removes the emotional pressure. It allows the trader to follow the structural development of the market without panic. The professional trader understands that the market must be given room to breathe. Sizing mistakes are insidious. They do not appear immediately after the entry. They compound silently, eroding confidence and capital over a series of trades. These errors transform mechanical trading systems into emotional gambling. The following discussion analyzes 5 fatal sizing mistakes. These are the errors that routinely derail the campaigns of otherwise competent Wyckoff technicians. Avoiding these pitfalls is mandatory for long-term consistency. The risk calculation must always trump the entry fascination. The first fatal error involves miscalculating the trade size relative to the chart structure. This mistake centers on sizing based on the account balance, rather than the required structural stop loss. Many traders fixate on a fixed dollar amount derived from their overall capital. They decide to risk exactly 1% of their total account value, regardless of the current volatility or schematic phase. This decision is often made before consulting the price chart. For example, a trader might determine their maximum allowable risk is $1,000 per trade. The Wyckoff methodology, however, demands a structural stop-loss placement. This stop must be positioned where the market thesis is definitively invalidated. In an accumulation schematic, the stop must logically sit below the lowest point of the selling climax or the subsequent secondary test. This necessary distance is defined by the market structure itself. It is not defined by the trader's arbitrary dollar preference. When the structural distance is wide, the trader faces a significant conflict. If the distance from the entry price to the structural stop is 10 points, risking $1,000 means buying precisely 100 shares. If the trader attempts to buy more than 100 shares, the total risk exceeds their 1% limit. To force a larger position size, the trader must shrink the stop-loss distance. This results in an arbitrary placement of the stop. The stop is then moved inside the critical support zone that the professionals are testing. The natural, necessary movement of the automatic reaction or the secondary test becomes enough to trigger a premature exit. The market does not respect the trader's fixed risk percentage. It only respects the true structural boundaries of supply and demand. The professional approach reverses this calculation entirely. The initial step must always be to identify the required structural stop-loss distance first. This distance determines the risk per share. Only then does the trader calculate the position size that aligns with their maximum acceptable capital risk. If the structural distance is wide, the position size must be small. If the resulting size is too small to justify the effort of the trade, the opportunity must be ignored. Position sizing is not about maximizing exposure to the market. It is strictly about maintaining structural integrity within the confines of capital preservation rules. Ignoring the distance defined by the chart structure is the quickest path to being shaken out of an otherwise sound Wyckoff campaign. The structural integrity of a trade is directly tied to the current phase of the Wyckoff schematic. Mistake 2 involves applying a fixed position size across all phases of the schematic. This approach ignores the shifting volatility inherent in the market structure. Volatility is not static. It changes dramatically as the market moves from initial shock toward eventual markup or markdown. Consider the market behavior during Phase A of accumulation. This initial phase is characterized by extreme volatility and wide swings. High volume spikes accompany the selling climax and the automatic reaction. The market is violently searching for a temporary balance. Position sizing during this chaotic period must be extremely conservative. The distance required for a safe structural stop-loss is necessarily wide. A wide stop-loss distance mandates a smaller position size if the financial risk is to remain constant. The professional trader allocates less capital when the required stop-loss is wide and unpredictable. A common error is treating a trade setup near the selling climax, the same as a test in Phase D. This leads to immediate overexposure and guarantees that the position will be shaken out by normal fluctuation. The market volatility is the true measure of immediate risk, not simply the total account balance. As the market progresses into Phase B, the volatility often begins to contract. The trading range becomes clearer, defined by the established high and low points. The secondary tests allow for more precise stop placement. This precision allows for a calculated increase in position size relative to the risk taken. The tightest sizing opportunities often appear during Phase C. Setups like the spring or the upthrust after distribution provide definitive points of failure or success. Because the required stop-loss for these critical tests can be very tight, the position size can be maximized relative to the structural risk. This is a temporary advantage, capitalizing on a moment of maximum definition. Failing to adjust sizing based on the volatility context means the trader is taking undue risk during the most volatile periods and underutilizing capital during the clearest, lowest risk entries. This principle applies equally during distribution schematics. A short position initiated near the buying climax requires minimal exposure due to the high volatility. Conversely, a position initiated after the upthrust after distribution, where the structure is confirmed and tight, allows for greater initial sizing based on the immediate structural risk definition. The schematic phase dictates the appropriate size, ensuring that the risk remains consistent even as the distance to the structural stop-loss changes dramatically. The professional trader does not stop the analysis at the immediate structural risk. Wyckoff's second law, cause and effect, must dominate the final sizing decision. This law dictates that the magnitude of the resulting move, the effect, must be proportional to the size of the structure that preceded it, the cause. The cause is the prolonged period of accumulation or distribution defined by the schematic. A fatal sizing mistake is ignoring this ratio entirely. Many traders size their positions strictly based on the defined stop-loss distance. They fail to quantify the potential reward relative to the effort the market expended building the base. This means a trader might deploy maximum capital on a small base structure. Even if the stop-loss is tight, the potential reward, the effect, may not justify the aggressive sizing. Wyckoff provided a precise tool for quantifying the cause. This is the horizontal point and figure count. This count measures the necessary preparation required by the composite operator before launching the subsequent markup or markdown campaign. The count provides the quantitative expectation of the move's duration and scope. This expectation must directly influence the position size. If the point and figure count suggests only a modest price target, The position sizing must reflect that limited potential. Aggressive sizing is reserved for campaigns where the market has spent significant time building a vast confirmed structure. Failing to quantify the effect creates a severe imbalance in capital deployment. A trader might take a maximum allowable risk percentage on a setup that only promises a 2-to-1 reward ratio. This violates the core principles of capital management and campaign viability. The proper approach involves scaling the position size to the target derived from the cause. If the market has only accumulated a small cause, the trader must reduce the initial size, even if the technical entry looks perfect. This preserves capital for the truly massive opportunities. The largest size is deployed only when the potential effect, quantified by the horizontal count, justifies the full risk allocation for a prolonged campaign. And this ensures that the capital deployed is always commensurate with the expected profit potential. The trader avoids wasting large risk allocations on short-term moves that lack the necessary structural foundation. The structural foundation provides the necessary justification for a campaign. However, structural justification is not the same as immediate confirmation. The fourth fatal position sizing mistake involves over-concentrating capital during the initial testing phases of a schematic. This error is frequently observed around the market's spring action in accumulation, or the secondary test. These points represent areas of peak volatility and maximum uncertainty. The professional operator is actively shaking out weak holders during these tests. The stop-loss requirement at the spring is typically wide. It must accommodate the inevitable volatility and potential retests of the selling climax low. A wider stop-loss combined with a maximum position size leads directly to excessive risk exposure. The spring action is specifically designed to trap aggressive buyers. They commit capital too early, believing the low is in. The initial entry during the testing phase should utilize a smaller foundational position size. This position serves as reconnaissance. It confirms the commitment of demand before the bulk of the capital is deployed. The misguided trader, reacting emotionally to the sharp reversal after the spring, commits their full risk allocation immediately. They believe the entire campaign is about to launch without further resistance. If the test fails, or if the market simply needs more time to absorb supply, the resulting volatility forces the trader out at a disproportionately large loss. This loss occurs precisely when the schematic integrity is still being established. Successful Wyckoff traders understand that the initial testing phase is only the beginning of the cause-building process. It is not the point for maximum commitment. The correct strategy dictates waiting for the market to prove the integrity of the accumulation structure. The primary capital deployment should be reserved for points where the risk is better defined. This includes the subsequent sign of strength, or, ideally, the backup to the edge of the creek, following the breakout of the creek. At the backup to the edge of the creek, the market has confirmed the absorption of supply. It has shifted into the markup phase. More importantly, the stop-loss can be placed tighter against the confirmed support level. This allows the trader to increase the position size safely while maintaining the predetermined 2% risk limit for the entire campaign. Committing maximum capital at the spring violates the principle of scaling in based on confirmed market action. It risks substantial capital in the most uncertain, volatile environment. This mistake dramatically reduces the trader's ability to participate when the campaign finally begins its sustained advance. The risks associated with the spring in accumulation are mirrored precisely by the risks at the upthrust after distribution. This is the fourth major position sizing mistake. In the distribution schematic, the market professional is testing the final remaining demand. This action is designed specifically to trap the last buyers. It provides the final, most defined entry point for the short campaign. Traders often make a severe sizing error by initiating short positions prematurely. They attempt to fade the rally before the actual upthrust after distribution occurs. This premature entry forces the protective stop-loss to be placed far away. The stop-loss must typically sit above the previous high of the entire trading range. Consequently, the position size must be drastically reduced to maintain the fixed risk percentage. For those seeking the foundational wisdom directly from the source, consider Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the essential text for understanding risk, stop losses, and judging market action by its own performance. It is the annotated edition by Max Davidson. This version provides the original timeless wisdom, but includes crucial clarifying notes and annotations. It is the core Wyckoff material presented clearly for the serious student. The link to this book is in the description below. When the true upthrust after distribution finally develops, the professional short signal is confirmed. This event offers the lowest risk entry point of the entire distribution schematic. The structural stop loss required for the upthrust after distribution is extremely tight. It is placed just above the temporary high of the action. This tight stop loss allows the professional trader to deploy the maximum calculated risk capital for the initial position. The distance from the entry price to the structural protective stop defines the position size. If that distance is unnecessarily wide, the potential position size shrinks significantly. The upthrust after distribution confirms the market's inability to sustain higher prices. It defines a very clear level of supply commitment. The professional trader sizes the position based on the distance from the entry to the peak of the upthrust. This precise measurement ensures that the calculated risk per trade remains constant, regardless of price volatility. Improper sizing at this critical juncture means missing the best risk-to-reward opportunity in the entire distribution campaign. The mistake is not necessarily fading the rally, but placing the largest initial risk capital before the final confirmation of supply has occurred. The market requires confirmation that demand has been exhausted. The trader whose size is too small at the upthrust after distribution then faces a difficult dilemma. They must either increase size later, chasing the market lower, or accept a dramatically undersized position for the entire primary move. This failure to capitalize on the narrowest structural stop loss is a critical error in risk allocation. It violates the core Wyckoff principle of maximizing opportunity when risk is minimized. The professional trader approaches position sizing differently. They view the entry not as a single event, but as a strategic campaign. This campaign requires disciplined scaling into the position. Pyramiding is the systematic addition of size. It is done only when the market confirms the initial structural analysis. Wyckoff taught that position size should increase only after the trade has become profitable. This reduces the overall risk exposure of the total position. The professional uses the schematic structure to define these specific scaling points. The initial entry might be taken at the spring or the initial secondary test. This is often the smallest capital allocation. It carries the highest risk relative to the position size because the confirmation is minimal. If the market successfully moves into phase C, the trader may look to add size. This addition occurs when the market tests the creek or confirms the preliminary support. The market is now validating the accumulation structure. The most important scaling point occurs after the sign of strength or the sign of weakness. This move confirms the commitment of the composite operator. The market has definitively left the confines of the trading range. When the market enters the markdown or markup phase, the structural stop loss can be tightened significantly. This tightening is critical for scaling. A shorter stop loss distance allows for a larger subsequent position size while maintaining the same dollar risk. This is the essence of professional pyramiding. The size of the position increases as the confidence in the structure increases. The risk exposure per unit of capital decreases as the trade progresses. Crucially, each addition must maintain the maximum allowable risk percentage for the entire campaign. Traders must continuously calculate the new average entry price. They must also assess the impact on the total capital exposed to the structural stop loss. A common error is adding size too aggressively after the initial move. This shifts the average entry price too far from the original structural support. If the market executes a final shakeout, this aggressive scaling can lead to an outsized loss. The disciplined trader uses scaling to manage volatility. They capitalize on moments when the market compresses its risk, such as the backup action to the edge of the trading range. This is the calculated, methodical approach to capital deployment that defines successful Wyckoff trading. Methodical capital deployment works in both directions. Just as professional positions are scaled into a developing trend, they must be scaled out when the campaign reaches maturity. This brings us to mistake 4, refusing to scale out as the market campaign becomes extended. Many traders are excellent at scaling into a developing trend. They capitalize on the clear risk structure of the accumulation phase. However, they struggle significantly when the time comes to harvest profits and reduce exposure. The campaign becomes extended when the cause has been fully realized. The market has traveled the distance quantified by the original trading range. Professional capital begins selling into strength during the final advance, or buying into weakness during the final decline. This behavior defines Phase E, the final stage of the schematic. Holding the full position size into Phase E is a severe sizing mistake. The reward potential diminishes drastically, often approaching zero. Simultaneously, the risk of a sharp automatic reaction or a major selling climax increases exponentially. The position sizing must reflect this profound shift in probability. The disciplined trader understands that capital preservation is the primary objective during market extension. They begin reducing exposure incrementally, following the structural signs of supply or demand exhaustion. For example, a trader might sell 1/3 of the position at the first sign of weakness, such as a clear upthrust after distribution failing to hold higher prices. Another third is removed upon the failure of a critical support level established during the final run-up. This scaling out process locks in accumulated profits. It ensures that a sudden structural reversal does not erase weeks or months of successful trading. The goal is to withdraw capital before the public is fully aware of the imminent change in trend. The rationale for scaling out differs completely from the rationale for scaling in. Scaling in uses volatility compression to define tight stop losses and increase initial aggression. Scaling out uses momentum exhaustion and structural weakness to define profit targets and reduce overall risk. The initial position size was large because the risk was clearly defined and controlled. The final position size must be small because the market is entering a period of high uncertainty and potential chaos. Refusing to scale out often stems from emotional attachment to the unrealized profit number. The trader fears missing the final parabolic move. Wyckoff emphasized that the structure dictates the action, not hope or fear. When the structure signals exhaustion, capital must be withdrawn. This prevents the fatal mistake of allowing a successful, profitable trade to turn into a painful loss. The professional trader always prioritizes realized capital over paper gains. The fifth fatal mistake is allowing emotional bias to override calculated risk. Position sizing is fundamentally a mathematical exercise. It must be treated as a mechanical function of volatility and the stop-loss placement. When emotion enters the process, the mathematics are abandoned. Greed is the primary emotional factor that destroys effective sizing strategies. Greed causes the trader to violate the established risk parameters. It encourages the use of excessive leverage, hoping to maximize the gain of a seemingly perfect entry point. The Wyckoff method teaches that market movements are finite. Capital campaigns move through accumulation, markdown, reaccumulation, and distribution phases. There is no such thing as an infinite run. The emotional bias toward infinite profit prevents the trader from scaling out when the structure signals exhaustion. This transforms paper gains into realized losses as supply overwhelms demand. The inverse emotional trap is fear. Fear often manifests as chronic undersizing. The technical analysis might indicate a high probability trade following a proper secondary test, but the commitment of capital is too small. This small sizing protects the account psychologically. However, it prevents any meaningful capital growth. The professional campaign requires proper capital commitment based purely on the defined risk. Another manifestation of fear is the refusal to accept a small loss. This fear causes the trader to move the structural stop loss, thereby invalidating the initial position sizing calculation. When the stop loss is moved, the entire risk profile of the trade changes instantly and dramatically. The risk management plan becomes useless. The professional mindset demands that the position size calculation is made only once. It happens before the trade is initiated, and it is based entirely on the distance to the structural stop. Wyckoff emphasized the necessity of strict objectivity. The schematic provides the roadmap, showing the cause built and the effect expected. If the market structure violates the schematic, the position size must be reduced or liquidated immediately. The structure dictates the action, not the desire for profit or the fear of being wrong. Position sizing must be viewed as an insurance policy. The premium paid is the calculated risk. Emotional attachment to the trade causes the trader to cancel the insurance policy just as the house begins to burn. Allowing ego to justify holding an oversized position through a clear distribution phase guarantees catastrophic capital destruction. The market does not care about the individual trader's opinion. It only responds to the objective forces of supply and demand. Discipline requires the trader to execute the plan, regardless of subjective feelings. Capital preservation depends on this cold, hard objectivity. The Master Wyckoff rule for consistent capital preservation. Capital preservation is the single non-negotiable duty of the professional trader. It supersedes the pursuit of profit. If the account cannot survive a series of expected losses, the trading campaign is structurally flawed from the start. Wyckoff emphasized treating speculative trading not as a casual pursuit, but as a serious business venture. Every robust business plan includes rigorous risk management protocols. The master rule, derived directly from Wyckoff's principles, is simple. Never risk more than a small fractional percentage of the total trading capital on any single position. This fractional risk limit, often set at 1% or 2%, ensures mathematical survival. It is the firewall against catastrophic destruction. When this rule is strictly enforced, a trader can endure 10 consecutive losing trades and still retain 90% of the initial capital. The statistical edge remains intact. The trader remains solvent and mentally capable of continuing the campaign. Position sizing is merely the mechanism used to enforce this master rule. The professional trader first determines the necessary distance to the structural stop loss. This distance is defined by the market's own action. It is the point where the schematic is invalidated. The trader then calculates the maximum allowable size that keeps the potential dollar loss within the fractional risk limit. If the structural stop loss requires too much capital to maintain the percentage rule, the trade is simply skipped. This disciplined approach ensures that the market's volatility never dictates the size of the loss. The trader dictates the risk before the entry is ever executed. The failure to adhere to this rule is the primary reason why high-potential setups ultimately lead to account destruction. Optimism overrides objectivity. The trader is tempted to over-leverage a setup perceived as a certainty. Wyckoff taught that there are no certainties in the market. There are only probabilities that must be managed through strict sizing. The professional operator understands that the market is designed to shake out the weak hands and destroy the undercapitalized. Survival depends on the cold, hard logic of defined risk. Consistent application of the fractional risk rule ensures that the trader can survive the inevitable drawdowns associated with the accumulation and distribution phases. It guarantees the trader is present for the next opportunity when the statistical edge finally plays out. This is the ultimate lesson of the Wyckoff method. Manage the risk first. Let the profits manage themselves. You can watch hundreds of hours of content and read dozens of books about the market. You are filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich, because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy in theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I have created a new channel called The Stoic Trader. I believe it will help many of you bridge these gaps. So if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.